Massive flows coming into the East African region. We know that we saw a 70% rise in the amount of investments made last year. Of course, we're starting to see this increasing quite extensively. What makes East Africa so attractive right now that we have seen such a massive increase of private equity flows?
Well, I think, the macroeconomic story is very strong in the region. If you look at Kenya, obviously is a hub in the region, and despite many of the challenges it had in the last couple of years, was still growing, expected to grow at 5% this year, GDP growth rate. And actually that's the laggard across the region. In average, we're looking at about 6 or 7% GDP growth rate. When you layer on top of that some of the sort of investment themes that are driving this inflow, it's the consumer demand story, which is very compelling. The regional integration of our economies, which is providing a much wider market, and just the improved macroeconomic management that is just making this a much more attractive investment destination.
Well, you mentioned consumer demand. Of course, that is definitely on the rise. We've also seen a lot of interest coming through for technological advances, and this is why the telecom sector has been one of the favorites when it comes to investment. Do you think we're going to start seeing other sectors of the economy start benefiting from the increase in flows?
Yeah, no, it's already happening. I guess the encouraging thing is, first of all, our own local investors are much more upbeat. Most of the capital that is being invested in the region is through expansions of existing companies, looking at the regional market opportunity. But in respect of the international flows, sure, technology is going to gather attention from the international markets, and increasingly, not necessarily just in this sort of traditional GSM space. We're seeing a whole range of value-added services, mobile banking platforms, and other technological innovations that are having a sort of a ripple effect on the economy. Other spaces that we are seeing substantial investment in areas of retail. We're seeing a lot of interest from international investors looking at the retail space. Looking at consumer goods, financial services is a very healthy space, which is generating a lot of interest from local and international investors, as well as sort of value-added processing and agriculture. We're seeing quite broad-based growth across the regional economy.
Well, Paul, let's talk about Catalyst Principal Partners. You're targeting, of course, $100 million of investment exclusively into the region. Tell us about the allocation of those funds.
Yeah, again, we're just sort of layering on top of what is already happening in the economy. So the whole consumer goods space, whether it be food and beverage, personal care, cosmetics, as the disposable income increases, more and more sort of semi-luxury items are being aspired to by the local consumer. Financial services and technology is allowing for banks to get deeper penetration into rural markets, rural economy. A lot of the cash that used to lay underneath the mattresses is now finding its way into the formal economy, driving mobile banking, mobile technology, etc. So we're looking at those spaces. We're very focused on, I guess, the local companies that are aspiring to be regional players of scale across the industrial space, services, and consumer space.
Well, it's $100 million now that, of course, you're talking about. What kind of targets have you set for the likes of the 2011 financial year and going forward, as, of course, as you mentioned, the retail space starts to increase significantly and consumer demand for various goods also starts to gain traction as growth in these countries starts to also recover quite extensively?
Well, we expect to make our first investment even as we close out the first year, for this financial year, specifically in the consumer goods space. We would expect to invest about a third of that capital in the first 12 months of next year, and then about a third each year thereafter. Within the $100 million, we are going to keep an industry limit of about 25% per core sector. So in the services, including financial services, no more than 25% of the fund, just to ensure that we get the diversification. as well as in the consumer space and others.
Well, that said,
but we are pretty upbeat.
Yeah. Well, that said, it's interesting to note that most investors and private equity funds are filtering through into the consumer space, technology space. One big thing that we are starting to see a little bit of lagging, it comes to the electricity and of course, energy space in Africa. Do you think that that trend could perhaps be reversed? And why do you think that investors are far more averse into heading into the electricity generation space, where, of course, a lot of growth potential lies?
Yeah, no, I think you're right. The potential is there, and we're seeing, as our economies grow, the demand for electricity will clearly grow. I think there is no shortage, actually, of capital looking at infrastructure, specifically in the electricity space. The challenge is deploying it into that space. And as you are aware, these are regulated industries, generally in economies, which require a combination of government and private sector collaboration. Negotiating the nature of those relationships is complex. The concession agreements, power purchase agreements, etc., can cause for transactions that we see as obvious. Those of us as a consumer, we know power is insufficient. See deals that take unnecessarily long periods of time to get completed. That, I think, is a major hindrance to getting investment into this sector. Now, the rationale is that you do have to have very rigorous controls and processes to ensure that governance is not abused when you're doing major investments into the economy. But sometimes we do get caught a little bit by form over substance. Process is critical, but we do need to find ways of streamlining the execution timeline to get these deals done.
Paul, I mean, we're talking about East Africa being relatively lucrative for investors at this point in time. Which other parts of the continent do you think are going to capture investors' attention? And I'm sure it's going to be quite a competitive environment to try and capture these funds. So just looking forward, perhaps you could even touch on some of the risks that lie ahead for not only the East African region, but also for Africa as a whole.
Yeah, look, I think Africa, relative to the other major economies, is in a good space in terms of our macroeconomic environment. We are seeing higher growth rates than the Western economies, the developed markets economies. So we will naturally tend to attract more capital. We are seeing a migration from some of the sort of larger Pan-African funds into some of the more regional or sector-specific areas. And you're going to have to be much more competitive in terms of your track record, your investment prospects, and your return expectations to be able to attract this capital. The risks remain in Africa. Governance remains a risk. Macroeconomic management remains a risk, and succession in terms of political campaigns, whether when a government changes hands, there's always going to be an element of risk. But I believe those risks are diminishing as we get more democratic processes in each of our economies.